In the last few years, Canada's economic landscape has been watching a potentially disastrous storm forming just over the horizon. A debt crisis, one that grows worse with each passing day. As it stands, Canadian debt has ballooned to record figures, and it's begun to draw the attention of economists, policymakers, and the entire public. And the initial prognosis does not look promising. The term debt crisis may sound abstract, but its implications are very real and far-reaching. It's a serious challenge for economists and politicians alike that has the potential to impact every Canadian, affecting job security, home ownership, and overall economic stability. Moreover, in our deeply interconnected global economy, a fiscal tremor in Canada would send shockwaves across the world. So, what is going on with Canada's economy, and how much debt is too much debt? If recent reports are true that Canada is deeper in debt than the government in Ottawa is letting on, does Canada have a ticking time bomb on its hands? And with the G7's highest household debt, nationwide climate-driven disasters, and punishing interest rates, does Canada feel like a house of cards waiting to collapse? To get a handle on Canada's debt crisis, we need to first differentiate between the different kinds of debt that burden Canadians. Consumer debt reflects individual borrowing, like credit card debt, which is usually for personal or household expenditures, whereas household debt represents the combined debt of a household, including consumer debt and mortgage loans, typically. Then there's government debt, often fueled by national borrowing to manage budget deficits or stimulate growth. It's a result of government spending and borrowing habits. Together, they weave the complex fabric of a nation's economy, each thread impacting everything from daily living to the broader economic landscape. And for Canadians, all three areas have taken on significant and concerning leverage. As of this September 2023, consumer debt in Canada hit a new record of over 2.4 trillion Canadian dollars. This includes 107.4 billion in credit card balances alone, with the average non-mortgage debt per consumer standing at about 21,131 Canadian dollars, according to a report by Equifax Canada. It's not hard to see how such numbers paint a clear picture of a population just trying to keep up. Such an incredible rise in consumer debt is fueled by several factors, including inflation, high interest rates, and fears of a potential recession, which have driven Canadians towards credit solutions, especially their credit cards, for financial relief. In the second quarter of 2023, the debt market in Canada also saw a moderate growth, with year-to-date loan issuance standing at 1.3 trillion CAD. All in all, the signs that Canadians are struggling with their debt load are continuing to rise. All of this comes at a time when consumer spending is expected to slow down over 2023 due to elevated inflation and high interest rates weighing down on consumer spending. Not to mention, Canadian households are also grappling with incomes that are beginning to stagnate. Despite an acceleration in wage growth and the historic worker shortages which defined the labour market throughout much of 2022, wages have still been struggling to keep pace with inflation. By November, average hourly earnings had surged about 10% compared to pre-pandemic levels, marking the swiftest pace over such a duration since the 1990s. However, this uptick fell short of matching the inflation rate, which skyrocketed 12% above its pre-crisis level, and has only continued to grow. Meanwhile, wage growth has cooled off even more in 2023. Altogether, the uptick in borrowing, driven mainly by the need for many Canadians to simply get by, is a symptom of a larger economic malaise, one that looks worse when household debt is factored in. Looking at Canada's household debt, a clear story begins to emerge. An economy and a country wrestling with higher living costs, creating a ripple of financial unease across the nation. But what does this translate to in real terms? And why is Canada's Mortgage and Housing Corporation's Deputy Chief Economist sounding the alarm that high household debt could lead to the worst? From July of 2018 to July of 2023, Canadian household debt has risen by almost $500 million. Moreover, by September, Canada's household debt reached a staggering $2.34 trillion. According to TransUnion's Credit Industry Insights report, that marks a 4.2% increase from this time last year, a jump of $94.8 billion. Such massive levels of debt mean that Canadian households are now more in debt than those in any other G7 country, and incredibly, the amount they owe is more than the value of the country's entire economy. Household debt now sits at 107% of Canada's GDP, according to a report from Canada's housing agency, the Canada Mortgage and Housing Corporation, which also points out the high risk this poses to its economy. It's also a percentage that has continued to grow ever higher in recent years. As recently as 2008, household debt in Canada was 80% of GDP, before rising to 95% by 2010 and eclipsing 100% during the pandemic. Like the rise in consumer debt, it's emblematic of a larger issue. Households across the country are finding it increasingly difficult to keep pace with skyrocketing costs of living, thus resorting to borrowing. By late 2021, Canada's household debt-to-income ratio had returned to pre-pandemic levels, and it's only worsened since, having soared to 180% by the final quarter of 2022. This means that households owe nearly twice as much as they earn, and it's a stark rise from the 88.77 recorded back in 1990. The debt burden is particularly pronounced among Canadians aged 46 to 55, who on average carry a household debt of $72,482, excluding mortgages. For the average Canadian, that number isn't much better. Even excluding mortgages, almost 6 out of 10 households are in debt, and the average sits at almost $41,500. To make matters worse, the landscape of household debt also extends to real estate secured debt, which includes both mortgage debt and home equity lines of credit. In June 2023 alone, the total credit liabilities of households increased by $4.2 billion, reaching a total of $2.86 trillion. Of this, real estate secured debt grew by $3.9 billion, whilst household mortgage debt increased by $4.6 billion. So what does this mean for the average household? A good indicator to look at is the debt service ratio, which represents the total household debt payments relative to personal disposable income. For Q1 of 2023, it was measured at 14.9%. That reflects a significant portion of income being directed towards paying debts. This ratio is forecasted to continue to rise in the coming months. And unfortunately, the picture gets worse. Delinquency rates are now nearing pre-pandemic levels for most consumer credit products. This means the rate of consumers that are over 90 days late on their debt payments for installment loans, credit cards, auto loans, and more recently for lines of credit have risen sharply. Consumer insolvencies are following the same trend, with over 25,000 in the fourth quarter of last year. When we take into account all of these figures, the weight of the debt burden on Canadian households becomes quite apparent. The situation prompts a deeper examination. How does this end? And more critically, what will be the ripple effects on Canada's economy and beyond? However, we can't even begin to answer that question until we look at the final area where Canada finds itself facing monumental challenges: government debt. The evolving story of Canada's public debt, both federal and provincial, is a tumultuous tale, the implications of which are still not understood and threaten all that Canadians value. For over a century, the debt hovered near zero but began a significant rise around the 1970s, and peaking sharply in the early 1990s. At that point, a period of stabilization ensued, and federal debt actually fell quite a bit. That is, until the financial crisis of 2008, after which it rapidly began increasing once again, carrying it by unprecedented heights by 2015, and even higher after the COVID-19 pandemic. To see just how bad the situation has become in recent years, one needs only point to the journey from a combined federal and provincial net debt of 1.1 trillion Canadian dollars in 2007 and 2008 to a projected 2.1 trillion Canadian dollars in 2022 and 2023. Such a massive increase is a clear reflection of the fiscal nightmare the Canadian government finds itself in today. In March 2023, Canada's national government debt is expected to reach 1.37 trillion US dollars. This is slightly lower compared to the all-time high of 1.47 trillion US dollars in March of the previous year. Yet the overall trajectory is of rising debt. The federal and provincial debt to GDP ratio also depicts a concerning picture. As a percentage of GDP, Canada's government debt had been hovering around 50% for most of the last decade. However, in 2021, it skyrocketed to about 73% of Canada's GDP and has only fallen a few percentage points in the last 2 years, remaining at an unsustainably high level. This isn't just about numbers on paper. The escalating government debt signals rising debt servicing costs, which in turn constricts the fiscal pace for critical public services like healthcare and education. The domino effect of high debt levels and debt servicing costs looms large, potentially impacting the ability of the government to provide essential public services if things worsen too much. Rising debt servicing cost among the private sector isn't any better, and it exceeds that of all other G7 countries and Australia. In fact, Canada today is considered the fourth most indebted advanced country across the globe. Now, addressing this growing debt menace requires a well-orchestrated long-term strategy, especially at a time when debt servicing costs are on the rise, persistent inflation gnaws at the economy, and fiscal firepower seems to be dwindling. However, the latest debt management strategy laid out by the Canadian government does aim to address these challenges. Whether the strategy proves successful or not, the rising tide of government debt remains far from an isolated challenge, but instead a piece of a larger fiscal puzzle. The myriad issues of fast-rising debt servicing costs, persistent inflation, and growing costs of living also test the resilience of the Canadian economy as a whole. From the consumer to the household to the government, Canada finds itself mired in a debt crisis of near epic proportions. How did it get to this point? Tracing back to the 2008 global financial crisis, Canada, like many nations, injected stimulus packages to revive the economy, marking the start of an upward drift in government debt. The global economic lull also impacted trade, a vital part of Canada's economy, denting government revenues and further straining the debt situation. Following this, the housing boom emerged as a significant driver of economic growth, yet it seeded rising household debt as soaring property prices propelled Canadians to borrow heavily to get on the property ladder. The strategy of maintaining low interest rates after 2008 in order to spur economic growth amidst the global economic downturn did foster growth, but it also kindled borrowing, inflating both consumer and household debt levels. Interest rates remained historically low for most of the 2010s, although that has changed drastically in 2023 as the Bank of Canada has hiked rates they believe may not be high enough, in fact. Still, groups like the Business Council of British Columbia remain worried by what they call the unexploded debt bomb. Then came COVID-19. The pandemic era demanded massive public health spending and economic stimulus, significantly bloating government debt. At the same time, the pandemic's financial impacts drove many towards increased borrowing in order to make ends meet through the most difficult and uncertain periods. Fast forward to the present, and rising costs of living have hit Canadians hard on just about every front. Prices have been spurred on by an inflation rate that is quickly surging to 30-year highs, nudging households and consumers towards borrowing to meet daily needs, fueling a never-ending cycle of borrowing and debt accumulation. Balancing economic growth, inflation control, and debt management has been a tightrope walk for policymakers as well. Crafting effective long-term strategies to manage and reduce debt across all sectors remains a significant hurdle. With the situation for Canadians looking dire due to the burgeoning debt crisis, what comes next is difficult to predict. Is the debt crisis indeed a ticking time bomb for Canada and the global economy? Considering that even the Bank of Canada is sounding the alarm, it's hard to feel optimistic. There's rising inflation on one side, and on the other, there's the need to keep interest rates low to foster economic growth and manage debt servicing costs. Yet these low interest rates can further fuel debt accumulation, creating a vicious cycle that's hard to break. As the debt load grows, so does the cost of servicing it. More revenue being diverted towards interest payments means less fiscal space for essential public services, hampering the government's ability to robustly respond to economic challenges. The housing market, often termed a bubble ready to burst, also remains a critical concern, especially reports that mortgage rates are still expected to rise. A potential correction could lead to a significant loss in household wealth, impacting consumer spending and in turn, economic growth. Transitioning from domestic concerns, Canada's economic trajectory has profound global implications. A recession in Canada could send shockwaves far beyond its borders, and being a significant player in the global market, a Canadian recession would impact global trade, investment, and financial markets, especially in the West. The effects on financial and commodity markets could destabilize global economic confidence, leading to a situation not unlike the financial crisis of 2008. But will there be a recession? Some economists are more optimistic than others and feel that the risk of a major economic shock is low. Unfortunately, a recession does seem to be the likeliest outcome at this point, with many financial agencies already predicting one for 2023. While those fears have not come true just yet, the debt crisis has also deepened, signalling matters are getting worse, not better. The effectiveness of a policy response by the Canadian government is a crucial determinant in the trajectory of the recession and the debt crisis. Interest rate hikes have significantly cooled Canada's housing market this year, which portends more economic slowdowns could be just beyond the horizon. All in all, the situation in Canada is not looking great. The massive buildup of consumer, household, and government debt presents a formidable challenge, both domestically and globally. As the scenario continues to unfold, the question of how Canada will respond will shape not only its economic future, but potentially the entire global financial landscape. It's a delicate dance of fiscal management that warrants a careful approach. However, many remain pessimistic. We're left with more questions than answers, poised on the cusp of an uncertain economic horizon, not just for Canada, but for the world at large. And so, only time will tell how this economic crisis will resolve.